Seven companies dominating half the stock market's gains. It sounds like science fiction, but in 2023, the Magnificent Seven stocks were responsible for over 50% of the S&P 500's 26.3% return. Today on Unlocking the Upside, we're diving into the fascinating world of stock market concentration.
Wow, that's an eye-opening statistic. How did we get to this point?
Well, it's been a dramatic shift over the past decade. From 2013 to 2024, the concentration of the US stock market, measured by the weighting of the top 10 stocks, nearly doubled from 14% to 27%. It's a staggering increase that sparked a lot of debate in the investment community.
I can imagine. What are some of the main concerns people are raising about this trend?
There's a whole range of worries out there. Some investors are concerned about the potential loss of diversification when so much of the market is concentrated in just a handful of stocks. Others are speculating whether we might be in a stock market bubble. There are also fears that the inflows into index funds have contributed to mindlessly bidding up these few dominant stocks.
Those all sound like valid concerns. But is this level of concentration really unprecedented?
That's a great question. While the current level is high, it's not entirely uncharted territory. In fact, it's approaching the prior peak of 30% that we saw back in 1963. It's also worth noting that this isn't just a US phenomenon. The MSCI All Country World Index shows a similar pattern, with the top 10 stocks making up about 19% of the total capitalization at the end of 2024, more than double the level from 10 years earlier.
Interesting. So, how many companies have actually managed to reach these top spots over time?
Well, that's one of the most fascinating aspects of this trend. Since 1950, only 17 companies have been among the top 3 in market capitalization at the end of any given year. And of those, only 11 have held a spot in the top 3 for more than 2 years. To put that in perspective, we're talking about a population of about 28,000 stocks that have been listed at any time since 1950.
Those are some incredibly long odds. Which companies have managed to stay at the top for the longest?
Companies like ExxonMobil, AT&T, IBM, General Electric, and Microsoft have spent the most time in those top positions over the years. But we've also seen newcomers like Nvidia recently breaking into the top 3, riding the wave of increased spending on artificial intelligence.
That's fascinating. But I can't help wondering, is this level of concentration actually a problem? Is there such a thing as a right level of concentration?
You know, that's an excellent question, and it's one that doesn't have a simple answer. One approach is to look at equity markets outside of the US for comparison. Interestingly, despite the recent increase in concentration, the US is still the 4th most diversified market among the largest global markets. At the end of 2024, markets like Switzerland, France, and Australia all had higher levels of concentration than the US.
That's surprising. Do you have any more extreme examples?
Absolutely. A study of 47 equity markets from 1989 to 2011 found that the average weighting of the top 10 positions was 48%, much higher than what we're seeing in the US now. And there have been even more extreme cases. For instance, in the early 2000s, Nokia alone made up about 2/3 of the total market capitalization of the Finnish market. And
that's mind-boggling. It makes our current situation seem almost tame by comparison. But what about the fundamental performance of these top companies? Is their increased market share justified?
Well, that's where it gets really interesting. When we look at the underlying fundamentals, we find that the change in market capitalization of the leading companies is indeed backed by value creation. One way to measure this is through economic profit, which takes into account both the return on invested capital and the cost of capital.
And what does the economic profit data tell us?
in 2024, the aggregate economic profit for US public companies was estimated to be close to $500 billion. The top 10 companies by market capitalization contributed 2/3 to that total. So while these top 10 stocks about 30% of the market capitalization, the companies earned nearly 70% of the economic profit. This pattern holds over time too. From 1990 to 2024, the top 10 stocks averaged 17% of the market capitalization, while the companies averaged nearly half of the economic profit. And
that's a striking difference. It suggests that the market capitalizations of these large companies aren't just a result of investor enthusiasm, but are actually supported by their fundamental performance. But what does all of this mean for active equity managers who are trying to outperform the market?
That's where things get really challenging for many fund managers. Rising stock market concentration is particularly difficult for active managers because on average they own stocks with smaller market capitalizations than those in their benchmarks. This means that when large cap stocks do well relative to small cap stocks, the percentage of mutual funds that outperform the benchmark tends to go down.
So the very structure of most actively managed funds puts them at a disadvantage when market concentration is rising. That seems like a significant hurdle to overcome.
Exactly, and we can see this play out in the data. In the 10 years through 2024, large cap stocks, as measured by the Russell 1000, delivered a compound annual total shareholder return around 12%, compared to just 7% for small caps, as measured by the Russell 2000. And large cap stocks outperformed small caps in 9 of those 10 years.
That's quite a headwind for active managers to overcome. But how have the actual top stocks performed over time? Is being at the top of the market cap list a guarantee of future outperformance?
That's a great question, and the answer might surprise you. Historically, owning the stock of the largest company has actually been a poor investment relative to the market overall. From 1950 to 2024, the top stock underperformed the S&P 500 by an average of 1.9% annually. However, the second and third largest stocks have fared much better, outperforming by an average of 2.6% and 1.6% annually, respectively. And
now that's unexpected. Has this pattern held true in recent years?
Actually, that's where things get really interesting. All of this changed dramatically in the past decade. From 2014 to 2024, the top 3 stocks all significantly outperformed the market. It's a significant shift that really underscores how unusual the past decade has been in terms of market dynamics.
That's fascinating. It seems like we're in uncharted territory in many ways. As we wrap up, what do you think are the key takeaways for investors trying to navigate this concentrated market environment?
Well, I think there are a few important points to keep in mind. First, while the current level of concentration is high, it's not unprecedented when we look at the historical context or compare it to other global markets. Second, the fundamental performance of the largest companies does provide some justification for their increased market share. It's not just a case of irrational exuberance, but reflects real value creation by these companies.
Those are great points. Any final thoughts for our listeners?
Absolutely. I think it's crucial to understand that this environment poses significant challenges for active managers, but it also potentially creates opportunities for those who can successfully identify the next generation of market leaders. And as always, it's important for investors to consider their own goals, risk tolerance, and investment horizon when deciding how to approach this concentrated market environment. There's no one-size-fits-all solution, but understanding these dynamics is crucial for making informed investment decisions in today's market.
Well said. It's clear that this is a complex issue without easy answers. But I feel like we've given our listeners a lot to think about. Thanks for this fascinating deep dive into stock market concentration.
It's been my pleasure. And to all our listeners, we hope this discussion has given you some valuable insights to consider as you navigate the current market landscape. Remember, in the world of investing, knowledge is power. Until next time, this is Unlocking the Upside from theinvestmentanalyst.com signing off. Have a great rest of week.